Welcome to this explainer breaking down the crucial tax e-news updates for June 2026. If you're navigating the landscape as a UK SME owner, a director, or a self-employed individual, you are absolutely in the right place. June 2026 is shaping up to be a pivotal month. We're looking at a unique combination of rapid-fire regulatory shifts and newly enforced compliance rules that you simply cannot afford to fall behind on. The stakes are particularly high right now because HMRC is actively shifting its focus from friendly guidance to aggressive enforcement in several key areas. So we're going to unpack these massive shifts that directly affect your bottom line, starting with some immediate cash-in-your-pocket savings and then moving right into those high-stakes compliance rules.
Here is a quick look at our roadmap for today. We'll be covering 1. Summer savings and VAT. 2. Tax-free mileage increases. 3. Self-assessment dividend rules. 4. R&D relief advance assurance. 5. An R&D case study. And 6. Employment status for football referees.
Section 1. Summer savings and VAT.
Okay, let's dive into this right away with some genuinely good news announced by Chancellor Rachel Reeves back on May 21, 2026. Now, this package is specifically aimed at cutting costs for families over the summer holidays, but it has some immediate, highly practical implications for businesses. If your business operates in hospitality or leisure, definitely pay close attention here. You must apply a temporary 5% reduced VAT rate between June 25th and September 1st, 2026 for qualifying activities. But the specific criteria are what make this a bit tricky. For example, if you run a restaurant or a cafe, the reduced rate applies to children's meals, and yes, that includes drinks, but only if the food is consumed on the premises. It specifically excludes takeaway food. It also covers children's tickets for cinemas and theaters, as well as general admission to qualifying family attractions like amusement parks, zoos, and museums, regardless of the customer's age. It's a fantastic boost for consumer spending, but on a practical level, this means you need your accounting and point-of-sale systems updated immediately to handle this temporary VAT shift. You have to ensure your tills are correctly distinguishing between a standard adult meal and a qualifying kids dine-in meal. Otherwise, your VAT return at the end of the quarter is going to be an absolute nightmare to unpick.
Section 2. Tax-free mileage increases.
Let's see how this next update builds your savings with a direct, tangible benefit for both employees and the self-employed, a highly anticipated boost to tax-free mileage rates. If you look at this table, notice the crucial shift for cars, vans, and goods vehicles. The flat rate for the first 10,000 miles has jumped significantly from 45p to 55p. This is for the 2026 to 2027 tax year, but importantly, it is actually backdated to April 2026. This backdating is a massive compliance detail because it means you can legitimately claim that extra 10p for any business journeys you've already made since the start of the tax year. But look closely at the rest of the data. The rates after 10,000 miles? They remain at 25p. Motorbikes stay at 24p, and bicycles are locked to 20p. It is a targeted increase, but a valuable one, effectively giving you a 10p per mile windfall on those first 10,000 miles. Just make sure your expense tracking software reflects this retroactive change so you don't miss out on the relief you're legally owed.
Section 3. Self-assessment dividend rules.
All right, shifting gears from financial savings to your responsibilities. The landscape is definitely changing. HMRC is actively tightening the reins on close company dividends for the upcoming 2025-26 self-assessment. If you're required to submit a self-assessment return, you're going to see some new boxes on the employment page. Just to be clear, a close company is generally a privately owned company controlled by 5 or fewer participators or any number of directors. For the vast majority of SME owners watching this explainer, that means you. To avoid issues, you'll now be required to run through a very strict checklist for every single directorship you hold. You need to explicitly state if it was a close company, provide the exact company name and registration number, detail the precise dividends you received from that company during the tax year, and declare the highest percentage shareholding you held during that time. This fundamentally changes how you report. It means your dividend procedures and record-keeping have to be meticulously lawful, completely transparent, and fully compliant right from day one of the tax year. The days of casually finalizing your dividend paperwork months after the fact are officially over.
And why does this matter so much? Because HMRC is aggressively stepping up its scrutiny of close company dividends. Failing to provide this specific, required information will trigger an immediate, mandatory penalty of £60. That is per instance. Mandatory. No excuses, no grace periods. If you hold multiple directorships and fail to report correctly on each one, those penalties are going to stack up incredibly fast. It's a crystal clear signal that HMRC is looking very closely at exactly how company profits are being extracted, and they're using these automated fines to force compliance.
Section 4. R&D Relief Advance Assurance.
For any SMEs out there undertaking research and development, we know navigating relief claims has historically been a bit of a minefield. However, it just got a brand new safety net with HMRC's Pilot Targeted Advance Assurance Service. Running alongside the existing full claim service, which was previously only available to first-time claimants, this new pilot scheme is open to any SME. It allows you to get proactive, upfront clarity on 4 specific, complex, and traditionally high-risk areas before you ever submit a claim. First, you can confirm if your project genuinely meets the definition of R&D for tax purposes. Second, you can check qualifying overseas expenditure. This is a huge risk area because recent rules heavily restricted claiming for R&D done outside the UK, so getting this signed off is crucial. Third, you can check contracted work eligibility, ensuring you actually own the R&D rights in HMRC's eyes. And finally, you can verify if you qualify for exemption from the PAYE and national insurance cap, which otherwise puts a ceiling on your cash credit based on your payroll size. Getting this assurance upfront on these notorious pitfalls can save you an immense amount of time, money, and audit stress down the line.
Section 5. R&D Pitfalls, a Case Study.
To understand exactly why seeking this upfront assurance matters so much, we have a recent cautionary tale from the First Tier Tribunal regarding a company called Beer Express Limited. It perfectly highlights the immense danger of relying on incompetent R&D advisors. When the Beer Express case went to the tribunal, the judges essentially had to answer this single critical question: did they resolve genuine technological uncertainty? This is because under the strict guidelines that set the scientific definitions HMRC uses, qualifying R&D requires aiming to achieve a tangible advance in science or technology by resolving a real technological uncertainty. It is absolutely not enough to merely improve your company's own internal processes, upgrade your software, or make something slightly more commercially efficient. You actually have to be pushing the boundaries of the field itself. The tribunal's findings in this case were, frankly, brutal. They found that the company's supporting reports were vague, totally unconvincing, and lacked any clear explanation of a technological baseline. Basically, they didn't even explain where the industry standard currently sat, making it impossible to prove they had advanced past it. Furthermore, there was no input from a competent professional, someone with actual, verifiable technical expertise in the specific field who could legitimately explain why the work qualified. The director of Beer Express was found to be a completely honest and credible guy, but he simply lacked the technical knowledge to defend the scientific validity of the claim himself. And the absolute worst part? When HMRC challenged this multi-thousand-pound claim, their so-called R&D advisor completely vanished, just disappeared, leaving this honest, unsuspecting director totally alone to defend a complex case he didn't technically understand. The tribunal dismissed the appeal entirely, stating the company had failed to discharge the burden of proof required to access R&D relief. And this brilliantly illustrates the ultimate takeaway for anyone making a tax claim. The responsibility, the liability, and the burden of proof always ultimately lie with you, the taxpayer. You cannot simply outsource your legal liability to a third party. This makes securing genuinely competent professional advice absolutely vital.
Section 6. Employment status, football referees.
Our final update covers a fascinating and long-running legal precedent regarding employment status. This involves Professional Game Match Officials Limited, better known as PGMOL, and their football referees. It went all the way up to the Supreme Court before being sent back down to the First Tier Tribunal. At the heart of this years-long legal battle was a seemingly simple question that affects thousands of businesses: employee or self-employed? HMRC heavily argued that the match fees paid to these referees should be subject to PAYE and national insurance because, in their view, the referees were essentially employees. The Supreme Court did establish there was some mutuality of obligation, meaning an obligation for the employer to provide work and the employee to accept it when a match was accepted, but the tribunal still had to weigh the overall picture of the relationship to answer this multi-million-pound question.
Look at this breakdown of what the tribunal found. Because the referees had no ongoing obligations to accept matches and PGMOL had no obligation to offer them, there was a huge level of flexibility where referees could just withdraw without sanction. The engagements were short, discreet, and completely separate for every single match. And finally, there was limited integration into the business, as most referees did this alongside other full-time jobs. Because of these combined factors, the tribunal officially ruled they lacked the core characteristics of employment and were legally self-employed. This means PGMOL did not owe years of backdated PAYE and national insurance. It's a massive victory for clarity on self-employment status, and it sets a vital precedent that everyday SMEs can rely on when hiring their own freelancers, showing that short, flexible, obligation-free contracts can genuinely withstand HMRC scrutiny.
So what does all of this tell us? Whether you're classifying the status of your freelance workers, you're an SME looking to claim R&D relief, or you're a director navigating the strict new VAT and self-assessment dividend rules, this explainer highlights one universal truth. The tax landscape is wildly complex, and the penalties for getting it wrong are severe. Proactive diligence and genuinely competent professional advice are your absolutely strongest defenses against a hefty, unexpected HMRC bill. As you review your own business operations and prepare for the rest of 2026, I want you to ask yourself this final question. Are you certain your current tax strategy is as compliant as it is cost-effective? Please don't wait for an HMRC inquiry to find out. Take these updates to heart, consult with your trusted tax professionals, and safeguard your finances moving forward. Thank you so much for joining me for this explainer, and stay proactive out there.